Hey, everybody, welcome to the Sense of Things, and it is our 100th show. Ron and I have been doing this for 2 years, almost to the day when we started a couple years ago, and just felt like we needed to start telling the story of the markets, the economy, and everything else. So, on today's show, we're going to take a look back at our market predictions from December and look at some of the market predictions that have been out there. We're going to talk a little bit about the CPI report that came out this morning, inflation report. We'll talk a little bit about the dollar, oil, and bonds, because bonds have been a major story over the last week. And of course, with all the tariff stuff, the markets have been all over the place. We had the most amazing day yesterday, and we're losing most of that back today. Pretty quickly. I think it's just a lot of trading going on in the markets. So stay tuned. We'll be right back on in just a minute. Hello, everybody. Welcome to the show. Ron, how are you doing, my friend?
Good morning. Happy 100th.
Happy 100th. We had a couple weeks off during the market craziness and the tariff craziness. It'll be fun to have a little bit of a conversation today.
I don't think we're going to squeeze it all in one podcast, so we'll do our best.
We'll be quick about it so that they don't. Yeah, they've already been through the ringer over the last couple of weeks. So you had a couple trivia questions to get us started.
Yeah, we got to continue the trivia and then get into a couple of interesting headlines because this market is headline driven. It is not news driven, and there is a difference. And then we're going to have a revisit of market forecast 4 months later. They're already revising, and it's always a comical situation. Yeah, let's start out with some of our trivia, and we'll go from there. So, what is the most frequently ordered item of food in the U.S.?
French fries.
One more guess.
Popcorn. I don't know.
Fried chicken.
Fried chicken. Okay, I get that.
I got to tell you, I love fried chicken, but my body does not like fried chicken.
Yeah, we're exporting that around the world because I know in China Kentucky Fried Chicken, people actually get married in Kentucky Fried Chickens, which I think is hilarious. But
wouldn't you?
Oh, of course.
Oh, that smell of grease is an aphrodisiac.
You want to remember that muscle memory in your brain for the rest of your life.
100%. How much does the average Thanksgiving turkey weigh? I actually got this right.
I'm going to say 9 pounds.
Oh, yeah. I know. It's definitely 15.
15. Okay.
Now, rather ironically, many times in the supermarket, they have the deals. I've gotten like a free turkey every year.
Yeah.
It's always like the average has always been like 18, 19, 20 pounds, but 15 is the average. That's what I figured. I've never seen a 9-pound turkey. That's a tiny bird.
Yeah, that's like just above a chicken. But yeah,
put it this way, if it's only 9 pounds, it probably isn't a Thanksgiving turkey.
Probably not. Yeah, we typically, just the two of us, will do like a 20, 22 pounder, and then we live off of that for months with different meals.
Quickly, what's the only state that has only one syllable?
Ohio. Oh, no, I guess that would be 2.
That's 3.
Ohio. Yeah.
4 letters, 3 syllables. Okay, one more. Come on, be quick.
Alaska. Damn, I don't even know. Delaware's more. Yeah, I don't even know.
It's an East Coast state.
Okay. Vermont.
Start from the top to the bottom.
Maine.
Ah! Come on, I had to feed you there.
Oh, I know you had to, because I'm like, okay, I'm going through all the ones like the.
That's why I said start from the top versus the bottom.
Got it.
All right, here we go. I love and I hate headlines because being a headline-driven market, that's what's been going on. And this Wall Street Journal page was from last week. This wasn't even from the insanity this week. And looking at the charts, and I was telling my people, I said, since Thursday to now, right? We're only talking 5 trading days. Today we're down, so 6 trading days. Really what it comes down to is we're going to be talking about these trading days and maybe the next week's worth of trading days for years.
Yep.
In 4 trading days, actually 3 trading days, we took out 1 year's worth of upward movement in the market. 3 trading days.
Yeah. And that was 1 year's worth. But if you look at it from the top of this year, from the peak of this year down. I mean, it was like a 25, 27% decline from top to bottom.
Yeah.
Which,
And it was self-inflicted. It could have been presented differently.
Yep.
Some of the things we needed to do, but everything's about packaging and presentation, and it could have been done differently. Let's leave that aside. But I thought the other interesting thing, because this has been inching up over the last year or two. I remember when it was 4.5, then it was 5, 5.5, 6. I remember when it hit 6.7, people were like, oh my God. All right. So now money market balances are now over 7%. Now
for
think
7
about the
million.
market's been going up, still have money market balances.
Yep.
You know, weren't people getting FOMO, fear of missing out, and adding money to the market in the last year? And basically all of 1 year's gains were gone.
Yeah.
So I thought this was interesting that it keeps piling up. And then, of course, our boy Warren Buffett, the smartest man in the world, he's got over 300 billion sitting in cash.
Yep. Which tells me that we're at a point where we get some of this trade stuff out of the way. Whatever you think about President Trump, and he sometimes is a bull in the China shop, he played China like a fiddle. And we've got 75 countries that are like, hey, we want to work with you.
Yeah, but it's not the four main ones, Jeff. Until we get the European Union, the entity, China, Canada, and Mexico, honestly, I could care less about the rest of them.
Yeah, the funny thing is, the biggest one that we really need to get in place is Japan. And China, you know what? China is going to just get forced into a corner, and they're not going to have a choice. When we have the whole rest of the world, or at least the main ones, China is really not going to be that big of a player. And for our goods, we sell one thing for every $5 that they bring into our country at that point. So it's going to hurt them way more than us.
Yeah.
I like the way it worked, and it worked out interestingly because everybody's, oh my God, the market's up. It's so great because the tariffs are removed. No, the pressure's still on because we're at that
It's a headline. Nothing's been agreed to.
Yeah. And we're at that 10% level. So it still keeps the pressure on a lot of these countries because we were only tariffing 2.5%. Now we're at 10. So it's going to keep the pressure on to get these countries to deal. And I hope in the next 90 days, we get a few resolved. It sounds like there's 15 that have made proposals to us at this point. So we're going to have to get that worked out. And I think once they get a few of these worked out, they'll have a model for what they want to do going forward, and it should get through these a lot faster.
I hope you're right.
I
am not as optimistic. And I know you, in your voice, you don't sound that optimistic.
I just
I'm
know,
not optimistic.
Yeah, I just know that yesterday, everybody's, oh my God, it was the greatest upward movement in one day ever, percentage wise, and all that. And I'm like, yep. And then it right again this morning, boom, comes
yesterday was more of, I think, a short squeeze than anything else.
Yep.
Yeah, it was a headline. First, we were way oversold.
Yep.
And between the short squeeze, yeah, I would have expected something like that announcement to be up 5% just on headline news.
Yeah. Yeah. Like I said, I mean, we've got a long way to go. They're going to have to get a few wins under their belt. As I go through the Treasury section of this podcast, I think people will understand why they made that announcement yesterday. From what I understand, President Trump made that one where it was like, okay, we were going to announce things slowly. We're going to do a big one to calm down the bond market a little bit, because it was that the bond market is behind the scenes what keeps money flowing.
Bond market's 5 to 10 times bigger than the equity market.
Yeah. And it keeps money flowing in the end out there. So that's the important part. All right. So what do we got from?
So here we go. I know we gave this again since, but I thought it was interesting that the S&P was at 5,800. It got to 61 and change. Yep. And we were talking, all right, hey, next year's going to be a good year, good policies, all this stuff. And all the market strategists, which we'll get to on the next slide, all looking for at least a 10 to a 12% upside. We'll get to it in a second. And we had our 2024 market forecast, which I was way off. And then we look at the 2025, and I remember I was telling people about my numbers that I was putting together down here at 51 to 5,200, saying, if we're going to go down, we're really going to go down. Meanwhile, we were under 5,000. So,
yeah.
And actually, I got the wrong date there. I apologize. That's supposed to be April. I don't think we've hit December yet. So it's supposed
No.
to be April 8th of the last. Yeah. So my point is that we are way off. And
Mm.
now when we're looking at the adjustments for this year, this is insane. Oppenheimer, that's a 15, almost a 13% reduction in theirs. Goldman Sachs didn't reduce it, but they came out and said 40% chance of recession. Then they came out the next day and basically said,
No, it's not.
base case is a recession. I did, some of these are just ridiculous. Yardeni, who's just a permeable when he sees stress and mentions it, but here he reduced it 900 basis points, 900 pips.
I stand by my numbers at this point.
This
And
is not even three and a half months into the year.
I
And they're
mean,
going to change it again. So this is what it comes down to. And actually, I just was quoted in an article that came out yesterday, and they had asked me this a month ago. I totally had forgotten about it, about what do you think about market forecasts? And the funny thing was, I stand by it a year ago. I stand by it in December. I stand by it a month ago when I was quoted. The whole thing is that this is for conversation only. You cannot plan your portfolio or your strategy around market forecasts.
Yep. Yeah, I personally think we're going to be above mine again. Last year, I came the closest, but we're still, honestly, we blew that out of the water. I think the back half of the year is going to be just absolutely unfreaking real.
If at least three of those four entities I talked about make deals, I would agree with you. I want to be optimistic, but I got to be realistic. I don't like to be pessimistic, but we'll have to see where things go, because here's the big thing. If these countries decide to collude in a way where, hey, we need to dig in our heels and stand our ground, this could get prolonged, and I don't care what anybody thinks.
Yeah. But I think the interesting part of all of this is, you've seen even the EU, which is probably one of the bigger ones we deal with, really more of their goods than ours going into their markets once again. But I don't see them colluding with China at this point. I think China's burned a lot of damn bridges over the years with their Belt and Road Initiative and stuff like that. I've heard interviews with the Italian prime minister, and she is just absolutely, she cannot stand the Chinese because of what they did in their country.
Here's the problem with the EU over China. China are proud people. They're going to dig in, I think, as long as they can. The only reason why I think the EU may take longer, you're dealing with a lot more chefs in the kitchen.
Yeah, that's exactly
right. To make a decision.
Yeah.
We'll see. All right,
I think, I think we're going to get Great Britain. We'll get them on our side pretty quick. They want a deal. Japan wants a deal. A lot of the Asian countries want a deal. I think in the end, it's going to be good for everybody. It's just going to take a little bit of time. Let me share my screen here real quick, and I will. Okay. And that just has that one screen on here, right? Yeah. Okay. So a couple things. Economic wise, there's really not a whole lot of economics going on this week at all. The big one this morning was CPI, Consumer Price Index, which came in at 2.4% year over year, which the estimate had been 2.6, prior one 2.8. So that means that we're seeing inflation cooling down continually, which is great. That doesn't mean that it's good for prices, because we're still super elevated from years ago, but it's slowing down a little bit. Of course, I've read all the pundits this morning, and but the tariffs haven't come into place yet, and then we're going to see all this. I don't think so, quite frankly. I think it's going to stay pretty stable. I don't think it's going to go down dramatically from here. I personally don't think we're going to see a recession this year. I may be wrong, but I think it's slowing down a little bit, which helps when it comes from that. So what are some of the things that might be affecting this? Let's first look at the dollar. So this is the dollar to the basket of currencies. Here's 2025. President Trump came in right about here. That was January 23rd. Somewhere in between there is when when he came into place. The dollar has been on a slide. I think a lot of that is a lot of countries have been buoying up their currencies. So they've been selling out of treasuries and buoying up their currencies during this time period. So the dollar's been on a decline. Not necessarily a bad thing, because a weaker dollar means that foreign currencies, when they buy our stuff, means they can buy more of our stuff. So getting some of this trade stuff worked out is a good thing.
Yeah, it's good for exports.
Yeah, great for exports. And that's what we're trying to get into. We don't want to be a complete weak dollar like we were during the Bush administration, but we want to pull that back because it was really at a massive high over here. All right. So let's talk a little bit about oil. Now, once again, Ron and I both tell you we don't like investing directly in oil. I don't like investing in oil companies. Now, I will invest in stuff that's close to the wellhead, pipelines and drillers and stuff like that, because those guys, when there's more production, they make more money, or when they're a toll booth, they make more money. Here is the price of oil over that same time period. And if you'll notice, it follows this. Why? Because oil is denominated in dollars. So part of this is oil's been coming down because of increased production, but that hasn't really ramped up yet. This is largely a dollar story, and you see the dollar dropping off massively. Oil dropped off massively over this last few days. That said, one of the things that's interesting to me is watching the...
Oh, by the way, I have no idea. People always ask me, where's the oil price going? I have no idea.
No idea.
Why is it going down? So they're pumping more oil out. But here's the interesting thing. The average cost to get a barrel of oil out of the ground in the US is over $50.
Yeah.
Saudi Arabia is in the teens.
Yeah.
$15 or something like that.
Yeah. And that's compressed their margins a little bit. I honestly don't think production's up, and they're just now granting leases on federal lands and stuff like that. So we're not going to see anything from a production standpoint for 2-3 years down the road at this point. So I think it's largely just a dollar story that's pulled that down. Now, the interesting thing is gas prices have been steadily on a rise during this time period, which always frustrates me because I'm like, how can this happen and then this happened at the same time? I don't know. It might be that downstream production, it's just taking time for that to work out. And with lower oil prices, we might see gas prices start to dip off here. But it's just frustrating. And that's why I don't like investing in any of this stuff, because I don't understand it. One thing I do want to cover, though, is looking at the Strategic Petroleum Reserve. So when we look at Strategic Petroleum Reserve over the last 3 years, and actually if we go out 5 years, we were way up here, 656 million barrels, or billion barrels, I think. The max capacity of that world there, or the max capacity of our Strategic Petroleum Reserve, is like up in the 700 billion barrel range. So this
I think it is million.
It is million? Okay. Yeah. I guess it is million. Yeah. So 600 million barrels. And then during the Biden White House, to try and push oil prices down, they kept dumping out of the Strategic Petroleum Reserve just down to 346 at the bottom end, and then slowly started to rebuild from there. Of course, buying into the highest oil prices ever, which is just completely stupid. But if you notice what's been going on with the Trump White House.
Go back 10 years.
I can't. I don't have the subscription. Yeah.
5 years. Go back 5 years.
Yeah.
So that's where we were. Okay.
This is the high point from what I can see. We were up there. We were almost at max capacity, and then they whittled it down.
Gotcha.
Now, if we start to look at it 6 months out, the Trump White House, if they came in, they're continuing to do it, but I don't think they're buying at a very rapid clip, for the simple fact that I think if they were buying at a rapid clip, they'd push oil prices back up. And that's not a good thing at that point. I think this nice, steady, stable, there's going to be a new company managing the Strategic Petroleum Reserve, but they won't be in place until like late May. So this is just, Department of Energy doing their normal thing of saying, okay, we're just going to slowly rebuild this over time. But we got a long ways to go to get it anywhere close to where it should be. So now let's talk a little bit about Treasuries. That's the oil story, and I thought it was just an interesting piece. Let's look a little bit at Treasuries. So these are 3, and I'll go over 3 ETFs that I will say I personally use in portfolios for clients, but There are three sleeves basically of ETFs. The 1 to 3 year Treasury, which is the SHY. If you look at it here over the last month or so, it's been on a nice, steady, stable up, and then it pulled back pretty dramatically here, or it got super volatile over the last few days. Massive amounts of trading in the SHY because bond prices started to move. The TLH were there. This is where the most volatility has been. And I think that's the normal place for a lot of volatility there in the center. We saw a big pullback. And then this is the TLTW, which is the 20-year Treasury, 20-plus year Treasury buy right strategy, which is something I use for yield in portfolios. You look at all of these, we had this massive drop off here over the last few days. And of course, I've had clients reaching out to me. What's going on?
Tough to manage risk with that volatility.
Say what?
The banks and the institutions, tough to manage risk.
Yeah, it is. And that's the problem. When you think banks, insurance companies, all that, it's a massive amount of risk. So the explanation that I've heard was all these countries got together and they started selling treasuries so that they could buy their currencies and all that. Yeah, I'm sure that was going on, but it didn't happen over just a few days. So what is this? And what was the cause of some of this? This is absolutely hedge funds and large asset managers deleveraging their portfolios. It's what's called a carry trade, and or not carry trade, but a base trade, where they're buying treasuries on margin. Treasury margins are much, much higher than, let's say, if you were margining a stock. A stock, you can only margin like 50%. A treasury, you can lever up like 10 times. So something happened last week where all of a sudden these guys deleveraged super fast because they might have seen some additional selling from countries and stuff like that. But this,
I think it was China and Japan and some of the other countries dumping their treasuries, no doubt.
Yeah, and I think that was part of it, but you don't get this. They don't just go out there and go, oh, we're just going to dump all this and sell it in the market. This is delevering from hedge funds. What do I see happening? I think we're going to stabilize here a little bit now, and we'll be back on a trend again. We buy them for safety and to clip coupons from that point. So last but not least, I wanted to cover our good old friend, the Treasury yield curve, because it was interesting to watch this. We actually are
move yesterday.
Yeah, back to where we were or where we should be at this point. But if you watch it over the last week here, it's been interesting to watch how we were in this kind of weird barbell here where short-term rates and long-term rates were kind of in parity. And then all of a sudden you go back now to where we're at today, and we're back to what I would suggest we should be at. Although the short-term part of the curve, I still don't get at this point.
No, that's because people still see fear.
Yeah.
If they didn't see fear, that would be in the 3.5 to 3.8 range.
And the little blue, it's something I didn't notice about this chart before. And this is if you don't want to know what this is, US Treasury yield curve.com is where I get this from. This blue band in the center is actually the Fed funds upper and lower target rates. So that explains a lot of why the short-term market is there, because that's where the Feds put their range in at. So it's going to keep those up at this point. But what I would say is, with the way the yields are today, that's not necessarily indicating an inverted yield curve, which would indicate a recession at this point. So it's why I based my decision on, I don't think we're going to see a recession this year. Could be wrong, but I don't think we'll see a recession.
Let's revisit that conversation in June.
Exactly. July 4th, man, Independence Day, baby.
Liberation Day was liberating people from their money from the market.
Well, that's true. Yeah,
we'll see what happens at Independence.
We'll see on Independence Day here. You just got to hang out. You got to be in the market. Yes, we'll make adjustments and moves around what we're invested in, but you can't go run and hide and sit in cash at this point.
I'll just keep adding to the quality positions. So it'll be spoiled on the back end.
Yeah, and I think the biggest thing is we've seen that massive rise in money markets. If you're sitting there making 4% on a money market, why would you make a move at this point? Until we see that.
Right. And the last point to wrap up is we were expecting 2 to 3 cuts this year. Now they're looking at 5 or 6.
Yep.
If we get that far, high yield accounts will be in the 2.5, 2.7 range.
Yeah.
At that point, you got to put your money in the market.
Which is, then it's going to shift gears and that money's going to slide back into the markets. And it's probably going to go more towards risk assets at that point, which high yields, dividends, stuff like that to get a little bit better yield on your money.
I hear you.
All right, guys.
See, happy 100th again.
Happy 100th. Thank you all for being with us this whole time period. We really appreciate you listening every week. Love the comments y'all make. It's been fun having back and forth with a lot of you on YouTube. Make sure that you subscribe to the channel. And certainly we're continuing to do these shows for you so that we can kind of share with you where it's at. And Ron and I are sticking with our numbers. We're not adjusting anything. We're going to ride it out for the rest of the year. So thanks a lot. And we'll see you guys back here the very next time.